OpenAI is setting its sights on a blockbuster $500 billion valuation. $500 billion.
That makes it the most valuable private company in the world, now surpassing SpaceX.
Private companies like OpenAI and SpaceX have captured enormous investor enthusiasm in recent years, pushing their valuations sharply higher. Yet, despite all the headlines, there's been one limiting factor when it comes to investing in these companies. Because they're privately held, they've remained largely inaccessible to ordinary investors.
I think one of the biggest problems we have today is we're building this artificial intelligence. Most of the companies on the bleeding edge are private, and I think the best way we can make sure that it benefits all of humanity is to give people exposure to it.
Now, a new approach is emerging that could change that: tokenization. It offers retail investors a way to gain exposure to shares of private companies that were once out of reach.
The tokenization of investing becoming bigger. Republic announcing that it has launched a SpaceX token which mirrors the performance of private shares of the company.
Robinhood just launched what may be its most ambitious crypto push yet, offering tokenized shares of OpenAI and SpaceX to users across Europe.
I think it's perhaps one of the biggest innovations in capital markets, certainly in recent history.
Despite its appeal, there are concerns that tokenizing private companies could be a way to bypass long-standing regulations meant to protect investors.
With the token, it is an instrument not issued by the company. It's a side bet on the future prospects of the company.
So why have high-growth companies like OpenAI and SpaceX remain off-limits to ordinary investors? How does tokenization make it possible for them to gain exposure to these companies? And what are the key benefits and risks of this emerging technology?
A token is just a way to represent ownership of something. Now, we've been tokenizing assets in financial services for over 400 years. If you think about a traditional stock certificate, it's nothing more than a token of ownership. But now, with modern blockchain technology, we can create more tokens and transfer them more efficiently than ever before. And that is the beauty of it, so that we can represent in an easily tradable form things we couldn't do before.
One of the easiest tokenization projects that you may have heard of is a stablecoin, where basically you have a token representing $1 and you're able to use it over the blockchain and over the internet.
Tokenization provides the same promise to private markets that the internet has provided to commerce, which is how do you make it feasible for a ton more people to come in and cost effective, and how do you improve the tradability of it?
Now, some of those things weren't tradable for good reason. Private companies want to stay private, but some people want to get into these private companies. And we see people in the financial services sector providing workarounds that will allow people to speculate on the future of various companies without actually owning a piece of the action.
With tokenization, we're still in a place where the regulations and the government have not caught up with the innovation and the tech. But because regulations aren't even there in the government to be able to say this is how it works, there's strange nuances that go to it.
And that's what's going on with tokenization, that clever people have found workarounds that allow people to speculate on the future of private companies without actually owning a piece of the private company. So what you have is a side bet that you can trade back and forth, and then someday, if and when the company goes public, the side bet should converge with the value of the stock at that point, if it works.
One of the key advantages of tokenization, experts say, is in its potential to democratize investing by giving retail investors access to high-growth assets that would otherwise be out of reach.
It gives us the ability to invest in more different things. That's the key. With this technology, we can create new valuable, socially beneficial financial instruments that didn't exist before.
From the retail investor standpoint, the big problem with private markets access in its current form is adverse selection. So the great private companies, the ones that everyone wants to invest in, don't have a problem attracting capital.
And that's why an outfit like Robinhood, that is trying to democratize finance, says, hey, let's give people the opportunity to get in on companies like OpenAI and SpaceX.
Since the 1930s, retail has been kept out of private business. Now this is the first time where they'll be able to have access to the upside and not simply only be able to participate at the IPO level. Investing in private companies has a risk to it, but also that's where the greatest upside is.
The allure of private companies is the desire to get in early on the wealth creation when a successful business is built.
Let's say you are investing in Google at the earliest days when the valuation was in the 100,000s, right? And then now it's a multi-trillion-dollar company, and your ability to get access to that investment while it's private puts you in a much better position to have a larger return.
And there's good reason for retail investors to want in on the action. Private equity returns have historically outperformed public markets over the last 25 years. Yet, investing in private companies has mostly been limited to large institutions, such as private equity and venture capital funds, as well as high net worth individuals.
The idea is we want to protect people who aren't necessarily in the position to lose this amount of money investing in these private companies, especially when they may not have the net worth to be able to lose it.
So we retail investors basically get the exhaust when the companies finally do go public, and the people who built their wealth are basically cashing out.
Similarly, other U.S. laws designed to protect investors can also make it cumbersome for private companies to go public.
We have things like the Securities Act of 1933, and these laws require public companies to do many things. They have to disclose everything they're doing, they have to file periodic reports with the government, they have to obey corporate governance laws. All that costs money. For companies that don't think it's worthwhile to be public, they'll do their best to stay private. Now, because we can tokenize anything, you have to be very careful about what is being tokenized.
One major concern with tokenizing private companies is that investors may lack the same protections or rights as traditional shareholders.
If I own a share in the company, I'm a shareholder with well-defined legal rights. I can vote in the annual election. I can receive any dividends that are paid. If I have a token in a private company, it's not clear what legal rights I have. It is a side bet with the issuer of the token. Will they really actually deliver what they're implying they will? These things are, for the moment, rather untested.
In addition, experts say that company disclosures are essential to ensure ordinary investors have a level playing field.
Why do public markets require as much disclosure as they do is to give investors equal access to information, make it them as accessible as possible. We have a lot of rules on market structure to make it so investors are protected.
It is very fair that if you take away all these regulations, that it would be easy to go to unsophisticated investors and sell them dreams and just sort of take their money.
Now, are those the right set of standards? That is quite debatable. Many people, including the chair of our SEC, Mr. Atkins, basically think that some of those standards are too restrictive.
Tokenization is an innovation, and we at the SEC should be focused on how do we advance innovation in the marketplace. My whole goal is to make things transparent from the regulatory aspect and give people a firm foundation upon which to innovate.
But perhaps the biggest drawback of tokenization, the tokens themselves do not represent actual ownership in the underlying private companies. When Robinhood offered tokenized shares of OpenAI and SpaceX to users in Europe in June, OpenAI came out publicly and said it did not endorse the move.
We love that there's so much interest, but we want to make sure we're working with our investors the right way.
It is true that these are not technically equity. In and of itself, I don't think it's entirely relevant that it's not technically an equity instrument. What's important is that retail customers have an opportunity to get exposure to this asset, which is incredibly important.
With standard equity ownership, we have a century of experience of investor protection. With the tokens, the regulatory environment is still being worked out.
CNBC reached out to OpenAI and SpaceX to participate in the story, but did not hear back.
What we've seen in the crypto world is a group of people who are completely rethinking how we do financial services from the ground up. And sometimes they just end up reinventing the wheel. Sometimes they just end up reinventing fraud. But many of the things they've come up with actually will eventually provide value.
I do believe we're just at the beginning of the tokenization of all assets.
I think crypto trading is going to become the infrastructure layer behind real-world assets. I think tokenization is going to be the layer behind everything.
Tokenization is a great technology. Just because the technology exists, you have to make sure that the investors have the information they need to make informed choices.
As much as I do think that this is absolutely going to be the future, it's not something that I think is going to be the immediate future.
The biggest risk is the unknown unknowns. Given that the technology is relatively new, given that the regulatory environment is relatively untested. We're not completely sure what can go wrong.
There are mechanisms where we can ameliorate the negatives and make sure we get to what we really want to deliver, which is exposure to these very valuable assets that are at the frontier of technology that's disrupting everyday people's lives.
That's the promise of it. Now, will it pan out? We need to make sure we have the right consumer protections in place to make sure the fraudsters don't take advantage of us.
As for retail investors, experts agree the message is simple.
Biggest takeaway is always do your homework. Spending your time really educating yourself in the thing that you want to put your money into is my suggestion to anyone.
With private companies, you really have to do due diligence. How do you know what is going on inside that company? What am I buying? Who am I buying it from? What rights do I have? Unless you can answer those questions, you should probably stay away. Be like Warren Buffett. Don't invest in anything you don't understand.